Welcome back. It's a new week with new challenges and hopefully new things to learn. So let's see if we can progress with our audit curriculum. So this week we are looking at how are we going to respond to the risks that we identified last week based on our risk assessment on financial statement level. And then we also need to introduce you to the assertions so that you will be able to do the risk assessment at assertion level. So make sure that you know what's going on with regards to the assertions and also the response at financial statement level. Before you continue watching this video, I assume that you did watch the videos before the lecture preparation. So you had to watch the video on the response at financial statement level where I explained that in comprehensive detail. So if you haven't, then you need to stop this one and go back to that first so that you've got the background knowledge. And then there's also two short videos on assertions that was done by Amanda from Australia, which is quite comprehensive as well. So it will give you a good introduction to the assertions, and you should have a good understanding of what they are by now. So I just want to touch on some of them and go into a little bit more detail on some of the explanations. So if you haven't done the pre-work, stop it here, go back and make sure that you know what's going on with those before progressing into these week's lectures. Okay, if you have done so, welcome and let's continue. If you're thinking about the response at financial statement level, if you look at the study material, I actually gave you a summary of what the response is with regards to the time and the resources and the people, your team, our procedures and the timing. If you think that is this really that easy, it is. You need to just be able to identify and know what is applicable, and then you need to know where to find it in the book if you can't remember all of them, so that you can open it up. And that's one of the nice little things, is that you can write it from the book as is. So don't make life more difficult. That's the way it is. It's actually really that easy. So we usually test you only once, maybe twice, if you're really lucky, to see whether or not you've got a good memory and where to find the book. Because remember, you now have this book with you, so I just need to see whether or not you know when to use it. So make sure that the paragraphs are flagged in your book so that you know exactly where to find them in ISA 300 and also 240. Okay, so with that said, remember the ISA 330, just highlight this one, it's in paragraph A1 and 2 is the overall response, but you now need to read the one that's included in the ISA 315 document that's separate. Okay, so remember, because we've updated ISA 315, this will automatically also trickle down into the response, which is now the new updated 330. So if you read this on paragraph 154, or on page 154 from the new ISA standard, so you get ISA 315, and if you continue to page, it will tell you what's the adjustments in all the other standards. So there they're going to 200 and 220, I think, and then 300 they also have, and 240 there's a little bit, and then eventually we get to ISA 330. So the people that's repeating this course, the ones that's now struck through, that's the way that you studied it last year. It's now changed, so please make sure that you understand the changes and don't make the mistake of actually referring to the old ones, because this is now the new stuff. So the ones that's underlined, that's the ones that now changes, really only having an effect on the people that's repeating, because the new guys, you don't know anything yet, so you just study it as is, as this is law. All right, so you will see that everything that I've explained to you in the video for the preparation is actually from here, or ISA 240. Can you see emphasizing to the engagement team the need to maintain professional skepticism, assigning more experienced staff with special skills and experts, changing the nature, timing and extent of the direction and the supervision. So it's not just providing more supervision, you need to make changes to that. So I don't want to go into the detail. You've read it, and you also listened to me where I explain it in a bit more detail. Just remember, where do I get the team and the procedures? Remember, there's no heading or that. It's just to group them together so that I can figure it out in my mind. If it doesn't work for you, you study it off like a parrot. If it works for you, awesome, use it. Okay, where do I get the procedures? This continues into the elements of unpredictability, changing your strategy by doing performance materiality. Read through those and make sure that you understand. So if it's something that you don't understand, or wording or terminology, then you need to tell me, then I can explain that to you specifically. Okay. Alright, so I just want to touch on paragraph A2 for a second, because that's now addressing the timing and the amount of work. But can you see, if you, in the video that I did explain to you, I just said to you this is what you can do, but it's actually a little bit more tricky. So it's affected by your understanding of the internal controls. So the better the internal controls, the more I can rely on it, the more I can do an interim. If it's not working, then this is it. And that's what that paragraph actually explains to you. So what you had to pick up here is an ineffective internal control. So what happens if there's good internal controls? Can you see, I can then be more confident, and the reliability of the evidence generated by the internal controls is better, so therefore I can do more work interim. So interim date means that it's just prior to their year end. So whenever I go and visit the client before their financial year end, that is at an interim date. So I can do some of the work before and then come back and do it after the period end, if there are good controls in place. So remember, this is now based on your assessment for key controls and whether or not you're going to perform tests of control. So you should know what's going on there. Then the next one, see, here's the opposite. So if there's deficiencies in the internal control, so it means that it's not so great. So can you see, then I need to respond differently. So then I cannot do an interim if I don't rely on the information, because that doesn't help me at all. So I need to now continue, and what do I do? And that's where they give you these examples. Okay, conduct more audit procedure as at the period end and not at an interim date. So I'm not going to go before the time. Get more evidence from substantive procedures. Or remember, I said to you, if you don't know what a substantive procedure is, if it's not a test of control for now, it's going to be a substantive procedure. So hopefully after the discussion question, that will also get a little bit more clearer. And definitely in the second semester, you will be guru on substantive procedures. So hang on, we are going to show you what that is all about. So, but for the moment, if it's not a test of control, testing something that the internal controls are doing, it is a substantive procedure. Okay, and then obviously I can also increase the number of locations that I've got. All right, so that's about the end of the story for the response at financial statement level. It really is that easy. It's just stating certain things. So you just need to make sure that it's applicable in the scenario. So if I tell you that they've got one warehouse, you cannot say to me, increase the number of locations, because I mean, that's quite silly. What locations are you going to increase? They only have one. So be careful to not just do a mind dump, but carefully consider whether or not this is applicable in the situation. Also have a look at that opening balances one, but I've explained that in the video. So that's also just one of the small little things that might trip you up, but it's not the end of the world. Yeah, only one. It's going to take more time to write. That's actually where you now miss the boat. So it takes more time, and obviously auditing, you're under stress for writing and enough time. So that's where you pay the price, is writing too much that you don't get credit on. Okay, so I'm going to step off the response part. If you don't understand, please let me know. But remember, it's now response at a risk at a financial statement level. That's a possibility for fraud or for error. And then overall, what is going to be my response? So how am I going to address it? By increasing my team, by increasing my procedures, or by increasing the time and the resources as well. Okay, that's it. So let's jump over to the assertions part. So you're going to be bombarded with assertions as from here and going forward. So everything is going to be related to an assertion, because remember, you need to tell me what line item and what about that line item is going to be wrong. So, and that's where we get to the assertions. So hopefully you've watched the two videos from Amanda, where she explains to you how's it applied and what's the different type of assertions. Okay. So I just want to touch on it from the ISA's point of view. So where do we get the information from in the ISA? So once again, remember, we are in the new one. So that's the separate one, not the one in the book. It's no longer applicable and you cannot study from that one. So be careful. And the definition is actually different. They've elaborated on the definition and it makes more sense to me now. So I think this is now for the better. Okay. So what's the definition of an assertion? Representations, what does that mean? Okay, Representations is a funny little word to say to you that I'm acting or speaking on behalf of someone else. So I am being represented by a lawyer in court. So he talks on my behalf to the judge. So I don't stand up there and say this is my story. So can you see he's representing me in that one. So whatever he's saying is as if I would have said it, but he's got the more knowledge about it. So thinking about the financials, the management is actually making representations on behalf of the financial statements. So can you see here's also, what do they say? They say that something about the recognition, the measurement, the presentation, and the disclosure of the information in the financial statements. So they make a representation about the information on how did they actually recognize, measure, and present information in the financials. Okay. Why? Because it has to meet the applicable financial reporting framework. So what they say is, as far as we know, if you look at this financial statement, we've applied our minds and we are sure that we applied the financial reporting framework correctly in terms of the recognition, the measurement, and the disclosure of the information. So that's the representation that they make to us and to the world outside. It's not just to us as well. Okay. So that's what an assertion is. It's a representation. It's a statement about something that you think is true. What's part of the assertions definition, what I like is that they've added a little bit to say assertions are used by the auditor to consider different types of potential misstatements. So if I say to you, so okay, what's going to be the problem with the inventory? It's going to be quite difficult to say, okay, maybe it's calculated incorrectly. So okay, yes, I've addressed one area. But having different assertions, it forces me to actually think about, but what else could there be also wrong with this information? So there's different types of potential misstatement, looking at it from different point of views. Imagine if you're now walking around this amount. So from different point of views, where do I get misstatements from? Not just looking at it from straightforward, which is usually the number crunching that we do in accounting. Okay. So that's the definition part of it. So hopefully it makes a little bit more sense. Don't get too stressed up about the representation, but at least you know they're talking on behalf of the information. The statements can't say something. It talks to us number-wise, but they actually say, okay, we put this number here because this is how our understanding is of what's happened. Okay. What's the difference between control objectives and assertions? That's also a nice little question, and I'm pretty sure that you thought about this one. Okay. So control objectives is what I want my internal controls to achieve. Okay. Looking at that assessment, remember we do management's risk assessment process, so they think about what can go wrong, and then they implement controls to try and mitigate that risk. Okay. And those controls have to have some certain objective or purpose. So what's the purpose of implementing that control? From a reliable financial reporting point of view, this is what we want the internal controls to achieve. They need to have complete information, it should be accurate, and only valid transactions should be recorded. So that's the objective for the normal day-to-day transactions, and you will see most of the controls that you put in place for financial purposes wise is going to be able to link to that. So hopefully from a key control point of view, you should be able to link the completeness, accuracy, and validity. Moving over to the assertions, if I know that there's a possible of risk and I've implemented the controls and those controls are working very nicely, can you see that by the end of the day I can actually tell you in my financial statements, I can then make the representation that according to me everything's included and everything's accurate and everything's valid. So can you see the assertions very much the same as the control objective? So if it meets the objective, it's going to be able to allow me to make the representation that it is complete and accurate. So that those are exactly the same. Occurrence a little bit because we just tried to add a little bit. So once again, can you see validity and authorization is included in there, and then also pertain to, so I'll get to occurrence in just a second. And then we just look at it from a different point of view. Cutoff, you don't usually have internal controls that will actually address the cutoff, the classification, or the presentation. So it's not normally part of your internal control environment. So that's why we just look at it from a financial statement presentation point of view. Okay, so that's why we add a little bit. This slide, just to tell you from what is a control objective, this is just additional information. It's from the Public Company Accounting Oversight Board. So that's more on the USA side, where they actually give you a definition as to what's a control objective. So read through that. Don't stress too much about it, but just gives you some little bit more information. That's it. Okay. All right. So first of all, do you know where to find the assertions in the new ISA? If you don't know where to find them, you won't be able to use them. So hopefully you would have figured out that it is in A190. So if you open up the new standard, if you go to paragraph A190, you are going to find the assertions. Okay. And then they distinguish between assertions about account balance and transactions and events, and then also for account balances. So classes of transactions is the first one. There we get occurrence, completeness, accuracy, cut-off, classification, presentation that I had just now. So let's just visit occurrence for a second. Occurrence is a funny little thing because we usually look at it from 3 points of view. So the first one is this a valid transaction? So all the things that's included in my accounting records is valid because I've got a supporting document to show you. I can convince you that that is the transaction that took place. Okay. I was not there, but I can give you convincing evidence that something was happening there, and I've got proof that this is where the money transaction, this is where I get the documentation, this is where the inventory, I don't know if the inventory was actually received, but at least I've got some documentation, proof. Okay, so for occurrence, I always want to see whether or not that what you have, can you prove that that actually happened? Is this a valid transaction by way of a supporting document, for example? Usually that's the case. Then also thinking about authorization. So if there is something that somebody reviews and authorized this, can you see it also supports the occurrence thereof? So somebody else also had a look at it and they approved whether or not this is acceptable or not. So authorization is also part of the occurrence, and you will see we also include that into the validity going back to the control objectives. And then the third one, it pertains to, that's a funny little thing, pertains to the entity. It means that what is included is what you expect to be included. That's a funny thing. Okay, I didn't say anything else that you didn't know by now, but let me explain. So first of all, if you look at, say for instance, stationery, okay, your expectation is that there should only be stationery type of expenses included. So what would you like to see there? You will see Waltons, and you will see graffiti, you might see C&A, you might see Dean stationery, or whatever. It should be relating to that specific account balance. Okay, so what I expect to see there is actually included. So let's say, for example, you look at their general ledger and the description is McDonald's. Can you see that even though it might be a valid expense and I've got a supporting document and it was authorized, it doesn't really pertain to the account balance that I'm looking at. So can you see then something's wrong with regards to the occurrence? The same also goes on company level. So if I am now a car salesman, for example, okay, so I'm selling cars like second-hand cars or new cars, and then the revenue that I generate from that is for cars. So if all of a sudden I now have other types of income or expenses, so let's say for instance I do, say, let's say a mink coat, for example, or if I now do research and development, can you see that doesn't really pertain to my type of entity and my type of business? So it's not really a valid transaction. So that's where that pertains to. Is this what I expect it to be in terms of how they actually account for that as well? Okay. So I'm not going to go into too much detail on the other ones. I think you should have a good idea. The only thing that I do want to see or say is on the account balance side, remember it's accuracy, valuation, and allocation. So it's three things, but it's one assertion. So if you write it in future, please make sure that you have all three. So you can't just say accuracy for account balances, then you don't get the credit for it. But I think we'll get back in when we do more discussion, and especially when we do it on financials, on assertion level. Okay. So the next thing that I need to see is that I've got assertions for different types of things. Okay, so they do two categories. The first one, classes of transactions and events. Remember I said to you classes of transaction, it's basically just a summary of all the transactions that happen. It's all grouped together like total revenue. It's not just an amount at a specific point in time, it's a combined total. Alright, so these are the assertions. Hopefully you would have picked up that there's a small little acronym. So if you haven't picked it up yet, here it is. So I've got CAPO for my acronym to remember what is the assertions relating to the transactions and events. So that's basically the things that's on your splockie or your income statement. All right, so CAPO, if you don't know what that is, it's basically for the guitar players amongst us. A capo is the small little thing that they put over the strings that actually presses it down. So you change the pitch of the guitar by adding a capo. So just to explain to you what the word is all about, not really necessary, but what you want to know is capo is there's 3 C's and there's 3 letters after the C if you think about capo. So it's quite nice to understand and remember. Alright, what's the 3 C's? You will see at the top now. Completeness, cutoff and classification. Then we've got accuracy, presentation and occurrence. On the other side, we've got account balances and their related disclosures. Same situation. Something different. Rights and obligation. Remember, do I have the right to record this debtor or do I have the obligation to actually record this liability? Existence and occurrence very much the same, just from a different point of view. Completeness is completeness, classification is classification. Remember, there's the accuracy, valuation and allocation. 3 parts, 3 different things, and then presentation is present with both. Okay, what's the acronym? Recap. Okay, recap. C is in the middle. There's 2 C's, completeness and classification. There's 2 letters before and 2 letters after. So that's quite nice to remember. So how many C's? How many letters before or after? Capo, there's 3 letters afterwards. So that's just the 2 acronyms that I've got. If you've got something else, perfect, use that. If you don't, then use mine, but I'm going to refer to these. So if I say to you, remember, you need to do recap, you need to know where to talk, what I'm talking about. Or you need to do capo, then at least you also know what I'm talking about there. Okay. Alright, so that is about almost the end of the story. Just one little thing I want to mention is the concept of over and understatement. Okay, overstatement, you always look at it from your financial statement point of view. So the amount that's included in your financial statements. Is that amount overstated or is it understated? And hopefully your gut feeling will tell you overstatement means that it is what? Too much, okay? So whatever I do have in my financials, it's too much, it should have been less. Or understatement, if it's too little, I didn't include everything. So now the next question, yes, you thought about it, is what assertions will actually lead to an overstatement or an understatement. And that will be the underlying risk for that specific account balance. Okay, so if you think about it, if you think about occurrence, okay, or existence, it means that whatever is included in my financial statements, is it valid? Should it be there? Does that asset actually exist? Okay, is that the amount that I need to have, or do I need to go back and adjust it? So the occurrence, you start at the accounting records and you say, okay, is this now too much or too little? If I have invalid transactions, it would be overstated. Can you see there's too many things there, the amount is too large and I need to adjust it. What's the direction? Looking from where do I start? So can you see for occurrence and existence, it's going to be from the accounting record. So it's already recorded. Okay. Can I prove that it's true? So can I have a supporting document that actually tells me that? So can you see the moment that I start moving backwards from my accounting records, from wherever? So if I agree the inventory of the invoice amount to the delivery note, can you see that I'm moving backwards? So I'm actually testing for the occurrence of the transaction. Okay, so it's getting quite important to remember before we're going forward to the substantive procedures that we need to do, and also for identifying what's the underlying risk. So if you think about it, okay, thinking about assets and liabilities and income and expenses and equity. So that's the big 5 groups. Okay, what do you want to do with assets? You want to have them as much as possible. So what's the biggest risk? Overstatements. Again, you see the existence of assets is always going to be an issue. If you think about revenue, for example, once again, I want to be it as high as possible. So the underlying risk for revenue is always going to be occurrence. Did I not include fictitious transactions? That doesn't relate to that. So that's the ones that you need to have on that side. If we move over to the understatement, that means it's too little. It means that I didn't include everything, so that one's quite easy. It's completeness. It's always going to be completeness. Okay, so if I did not include all the inventory that I do own into my financial statements, can you see the balance that's disclosed in the financials is understated? It doesn't have everything included. Where's the direction? It's quite the opposite side of it. So then I'm going to go from the supporting documents or from the outside inventory, moving forward into my accounting records. So whatever I own or have or what happened, was that actually recorded in my accounting record? So is it complete in terms of what happened? Did I actually record that for the specific period? So that's the only ones that's really an issue with regards to the direction of where we look at it. Remember, thinking about overall understatement, it's always going to be from the financial statement amount in your financial statements. Is that amount too much or is it too little? And that's where we need to get to for the occurrence and the completeness. If you think about the other assertions, it could be either or. If you think about accuracy, I can have too much or too little if I did the calculation wrong. Cut off again. If I included it, it's overstated. If I didn't include it, it's understated. So it depends on what's the direction. So these are the only two that's really important with regards to the direction, and that's isolated and specific. The other ones could be an either or. Rights and obligation, either I do have the right or I don't have the right. So it can be over or understated depending on the situation. So be careful. But this one's always going to be an issue. And make sure that you understand the difference between the two. Okay. So time to practice from your side is, you will see in the study material there is a discussion question. Okay, not going to go into the detail. I want you to start practicing the knowledge that you have on the assertion. So there's 16 procedures that I've presented to you. You need to distinguish what's the assertion or assertions that's affected, what's the account balance or the total that's affected. Okay, whether or not this is a test of control or a substantive. Remember, you know now what a test of control is. If not a test of control, by default it's a substantive procedure. And then what's the underlying risk, because that's where we're moving towards for that procedure. So why are we doing that procedure? What's the risk that we're trying to address with that? So practice on there for the discussion question, and then you will see on the right hand side I've given you the detailed discussion as to how in the suggested solution, what should you be thinking, why do we have this as an answer. So hopefully that will answer most of your questions from that point of view. So if you have anything else that you're not 100% convinced of or know or understand, please give us a shout and write us an email. Okay. The discussion is on the solution, so please first do the question on your own and see whether or not you can apply the knowledge that you have for assertions up to this point. Okay, so what have we learned up to now? For planning, we are going at a great pace and we are almost at the end of our planning. So the only thing that's left is risk at a certain level and response at a certain level. So we are almost at the end of it. So what did we do? We do have an audit strategy. We calculated materiality. We obtained an understanding of this entity, the internal controls, as well as the computerized controls. Last week we had a look at audit risk. So we had a look at risk at financial statement level for the inherent risk, control risk, and detection risk, the fraud, the error, and the going concern. Okay, we've now added the response, which is basically just writing it from the ISO 330, and now we've added recap and capo as to the assertion. So I know now what the assertions are, so I can now look at the financial statements and the line items on the financials and then distinguish what's going to be the risk for that line item based on the entity. So that's the next step. See you soon. Stay awesome and bye-bye.